Hey guys, Chris from Depreciation here, and in this video, I'm going to show you the solution for question 1 from the Jan 2021 POA paper 2. When I finish all of the solutions, I'm going to compile it into a playlist, and I'm going to put a card up there and a link in the description below, so be sure to check it out. And before I jump into it, just one quick thing. I got some feedback from the last time I did past paper solutions, and people said that switching between the question paper and the solution was a bit annoying or jarring, so they prefer to have the question paper up with the solution at the same time. So that's the format I'm going to use in this video. But some of you have said that that particular format makes things too small for you to read, especially if you're on a smaller device like a phone. All right, so I'm going to need your feedback as to if this format works well for you or if you still find things are too small. And based on that, I'll make some adjustments in my upcoming videos. Okay guys, so let's get into it. All right, so on the left-hand side, you are seeing the question paper. On the right-hand side, you're seeing my little template. I'm just going to fill it out as we go along. So the first thing to do, and one of the most important things to do, is to read the question. So let's go. So it says, John Oinston is the owner of Oinston's Barber Salon. Okay. On 31st December 2020, he provided the following trial balance. So let's take a look. So we have capital, right? Credit balance. Accounts payable is a liability that has a credit balance 2. Right? Cash is an asset that has a debit balance. Drawings. So drawings is a reduction in capital. And therefore, oops, what is that? If it's a reduction in capital, it will have the opposite balance to the capital balance, which means if capital has a credit balance, drawings is going to have a debit balance. Nice. Next we have some expenses. So I'm seeing, well, 4 expenses here plus wages expense. Expenses have debit balances. So all of those are in the correct column. Now this thing here says receipts from customers. Sorry, let me see if I can highlight that item by itself. Right. Receipts from customers. So receipts from customers. So remember, what is John? What kind of business does John have? It's a barber salon. And therefore, he's providing a service. So he's not buying goods to resell. So there's not going to be any opening stock, purchases, returns out, carriage in, closing stock. And the sales revenue will come from providing his service of barbering. So that this line that says receipts from customers, that is your that is your revenue. Right? And it's in the credit column, which is correct as well. We talked about wages expense already. Okay, so furniture at cost, that's an asset, it's a non-current asset, and it has an associated provision for depreciation. So remember, the provision for depreciation's function is to reduce the value of the asset in the balance sheet. So if the asset has a debit balance, to reduce the debit balance, you have to have a credit balance. So that's why the provision for depreciation account for, well, any non-current asset will have a credit balance. Right? Same thing goes for equipment at cost and its associated provision for depreciation. The equipment itself is an asset, therefore it has a debit balance. The provision for depreciation will have a credit balance. Okay, now let's scroll down a little bit and we can take a look at some very important additional information. So the first thing is rent prepaid 800. So this is where we have our adjustments. So prepayments are deducted from the associated figure in the trial balance, assuming of course the trial balance is an unadjusted trial balance. Why do we subtract prepayments? Because if it's prepaid, it means it's paid before it was incurred. In other words, it's paid for a future period and therefore does not apply to the current financial period under consideration. And as such, it cannot therefore form part of the current period's profit calculation. So we have to extract it or remove it from the calculation. And to do so, we simply subtract it from the associated expense figure in the trial balance. Right? By the same token, we have general expenses unpaid. So unpaid is another word for accrued or owed or outstanding. Right? That's a liability. Now, just like we talked about for the rent prepaid, we would have to subtract rent prepaid. So for general expenses, we have an associated trial balance figure. And we'd have to add this accrued portion down here. Why? Because it was not paid, but it was supposed to be paid. It was incurred, which means it forms part of the current period's profit calculation. So therefore, we're going to have to add this 500 to this 1200 up here. Now, depreciation. Okay, so we have 2 non-current assets, and we have 2 different methods here. So for the equipment, it says 20% using the reducing balance, right? And for furniture, we have 5% using the straight line method. All right, so let me maximize the screen and let me scroll down just to show you guys there's no other additional information, but there is, as you know, a table, a format for you to fill in, and it's 9 marks. Now, a good rule of thumb is to spend 1.5 minutes per mark on any particular question. The reason is, well, that's just kind of how it works out. If you're budgeted 30 minutes a question, plus an additional 6 for like reading and checking over, all right? So let's call it 10 marks, so 10 by 1.5 is 15 minutes. So you want to spend about 15 minutes on this particular part of the question. Okay, let's go back up. Let's center it so we could see the information properly and clearly. And let's go across here. So of course, the first thing we need to do is we need to head up. So you put the name of the entity, or instance, Barber Salon, income statement for the year ended 31st December 2020. Cool. Put our dollar signs. Now, the first thing we want to put, because it's an income statement, basically you're doing revenue minus expenses. So revenue is the receipts, right? That's 31,007. And we're just going to put less expenses. And we're going to put, let's start, so we're going to start with the rent, right? And of course, as we talked about, rent prepaid has to be deducted. So you're going to see 4,000 minus 800, that's 3,200, right? I like to put my working in a little bracket next to the word itself. You may choose to do something different, but that's up to you. The next thing is electricity is 1,200. Then we have general expenses, which is also 1,200, but don't forget, we have an accrued portion for general expenses down here, which means we have to add that accrued portion to the 1,200. So 1,200 plus 500 is 1,700. Cool. Next we have supplies expense, whoops, and then wages expense. All right. So we're going to put supplies 1,000 and wages 3,000. Right. So now we get into the interesting part, the depreciation. Let's talk about the furniture first. That's the easier one. The straight line method is the easier method for depreciation. So it just says 5% per year using the straight line method. So what do? What we have to do is simply find 5% of the cost of the asset, right? And that's going to look like this, right? Depreciation, furniture, 5% of 10,000, 500. So some of you all are here asking, Chris, what about the formula? Cost minus residual value, all divided by the estimated useful life. Isn't that the formula for the depreciation expense for the straight line method? The answer is yes, that is the formula, but that's not the information we were given in this question. We were simply given a percentage. And if that's the information you were given, that's the information you have to use. Okay. Now, the equipment is being depreciated using the reducing balance method. There's one subtle difference, but subtle, albeit important and significant difference between the calculation for straight line and reducing balance method. For the straight line, we multiply the percentage by the cost of the asset. But for the reducing balance method, we have to multiply it by what we call the net book value. And the net book value is the cost of the asset minus any pre-existing depreciation on that asset. So what you're going to see, right, 20% of 18,000. Where did 18,000 come from? Once again, the cost of the asset, the equipment is 20,000. The existing provision is 2,000. 20 minus 2 is 18. Why are we subtracting them? Because under the reducing balance method, we multiply the percentage by the net book value. And what is net book value? Cost minus depreciation to date. That'll give us total expenses of 14,200, and subtracting that from the revenue will give us 17,500. So that's our net income. Okay, let's scroll down on this side, and we're going to take a look at the next requirement. So it says, all right, using the information on pages 4 and 5, which is, well, the trial balance plus the additional information and your income statement, prepare an extract of the statement of financial position for Oinstein's Barber Salon to show the value of non-current assets as at 31st December 2020. Okay, so we're going to go back up because we're going to need the information from on top here. And they want us to do an extract showing the non-current assets section. So for some of you all might not know the term non-current, that's the fixed assets. So I'm gonna scroll a bit down on this side so we can see things maybe a bit more clearly, a bit more center. All right, so again, head up. So you have, for instance, Barber Salon, statement of financial position extract as at 31st December 2020. So we have 3 columns, right? One is cost, then you just see me having depreciation. If you could fit it, put accumulated depreciation or provision for depreciation or depreciation to date, and NBV stands for net book value. Right? Remember, just now I was talking about the function of the provision for depreciation is to reduce the value of the asset in the balance sheet, right? Because that follows something that's called the historical cost concept, which says that assets must be presented at their depreciated historical cost, which means you have to show the cost, the original cost of the asset, minus the depreciation and the subsequent net book value. Now the furniture is 10,000. So that's going to go in this piece here. But the depreciation, you might be saying, all right, well, that's easy, that's 1,000. Nope. This 1,000 is the depreciation prior to doing the income statement. What that means is that the depreciation for the current year, up on this side here, the 500, that needs to be included because we've just charged that depreciation for the current year. So the depreciation that will go in the balance sheet is a combination of the 1,000, which was the depreciation from all the years before the current year, plus the 500, which is the current year's depreciation. So you're going to see 1,000 minus 1,500 equal to 8,500. And then you do the same thing for the equipment. You take the cost of the equipment and you subtract the new accumulated depreciation figure, which is the sum of the pre-existing depreciation plus up here in the income statement, the current year's depreciation charge of 3,600. So 2,000 plus 3,600 is going to give us 5,600. And we're simply going to put a total line for everything. Right? So if you add going down, you're going to get the totals. And of course, if you subtract going across, you're going to get the rightmost column totals. Okay. Now, how many marks was that? That was 3 marks. So 3 by 1.5 is 4.5 minutes. Let's say 5 minutes, right? So 15 minutes for the first part. Well, 9 and 3 is 12. 12 by 1.5 is 18. So yeah, you're at about 18 minutes so far. All right. Okay, now let's see what else they asked in this question. Okay, so let's try to move right. So below are descriptions of accounting adjustments in Oinston's Barber Salon. In the space provided, enter the letter code which represents the type of adjustment. Okay, so I've sort of recreated this table here, but I just didn't type out everything, all the long ones especially, word for word, because I wanted to kind of keep things compact and not have to do weird adjustments or weird modifications in the Excel spreadsheet. All right, so basically what they've done is they've given us these 6 types of adjustments: revenue, expenditure, net book value, depreciation, bad debts, accrued expense, and prepaid expense. And what they wanted to do is to match up the adjustment using its letter code with these words down here. So what they said is that the first one, an example has been done for you, which is the first one. So an account receivable is unable to pay the amount due. Account receivable is debtors. If a debtor is unable to pay the amount due, it means they cannot pay you, which means therefore you have to write off the bad debt. So that's going to be, as they showed us, option D. Oops. Clearly I have some trouble highlighting one item here. Wait. Right, option D. Forget it. Right. So across here now, right, account receivable is unable to pay the amount due. Boom, D. Okay. Now for the next 4, which is how we're going to get our marks. Outstanding invoices to be paid. So if we have outstanding invoices to be paid, that sounds like amounts that were incurred that we have not yet paid. So that sounds like accrued expenses. Do we have accrued expenses? Yeah, look at that. Option E, accrued expenses. So, sorry, right? So we're going to put that E. All right, next, non-current assets, loss in value. Non-current assets, as we said, is fixed assets. And if they lose value, that's depreciation, which is option C. Right? Yeah. Next one, expenditure incurred every day as daily operating expenses. Okay, well that's revenue expenditure. That's item A. Now just so you know, there are 2 types of expenditure. You have capital expenditure, which is expenditure on capital assets, fixed assets, non-current assets. And you have expenditure on, well, all other types of expenditure, anything but paying for new fixed assets or significantly improving them. So there's salaries, wages, rent, interest expense, insurance, advertising, marketing, all that stuff, all those things, those are revenue, items of revenue expenditure. Basically, you have to spend money in order to make money. And the money is spent to make money is called a revenue expenditure. So basically, any expense item you see in the income statement is revenue expenditure. Okay, last one, cost less depreciation to date. So we did that up in the balance sheet. Cost minus depreciation to date or accumulated depreciation is net book value, which is item B. All right, item B. And as you can see, they left item F unused, prepaid expense. Okay, all right, cool. Let's scroll down again to the next part of the question. All right, so we have a little bit of reading to do here. Always be sure to read properly. So it says here, Zahida received a check for this sum, of $8,000 for a debt of $12,000 from one of her customers, Yoshida, on the 31st of December 2018. So, Zahida received a check for $8,000 for a debt of $12,000. So she's paying off piece of the debt, all right? So she paid 8 out of 12, therefore she has $4,000 left. 1 year later, Yoshida stopped all payments to Zahida, and 2 years later, Zahida discovered that Yoshida is unable to clear the debt and that she must write it off. Okay, so what do they want us to do? Prepare the entry to record the bad debt written off in Zahida's books. So that's the person who has to write off the debt, not the debtor. No narrative is required. So I know I hear some of you rejoicing, okay, no narrative. Ladies and gents, writing a narrative for a journal entry is a fundamental accounting skill you should have. It's not that difficult. If you have difficulty, message me. I'll see if I can help you, okay? So we don't have to put one here. Now, I did recreate my general journal. So with general journal entries, the debit entry must go first. The credit entry comes second, and it is slightly indented as a matter of fact, all right? Now, what is the double entry? So first of all, when you are writing off a bad debt, you have to debit bad debts expense, right? We are debiting bad debts expense because the expense has now come into existence. So therefore, we have to record the expense coming into existence. So you're going to debit bad debts expense. And where does the credit go? Well, the other account affected by the transaction, well, not a transaction per se, but by this item, was Yoshida's account. Yoshida was a debtor. A debt is classified as an asset. Now, I know most of you all think, well, an asset is something we own. Yes, but we don't own Yoshida, all right? There's an extension to the definition of an asset that says an asset is also, listen to it, any benefit that the business can reasonably expect to receive within the foreseeable future, arising out of some past transaction. So that's exactly what an account receivable is. It's an amount of money, a benefit, we can reasonably expect to receive because we sold goods to somebody on credit and they agreed to pay us for those goods in the future, right? In the foreseeable future, arising out of a past transaction. But if we know for sure the debtor, Yoshida, cannot pay us, what does that tell us? It tells us we can no longer reasonably expect to receive that benefit in the foreseeable future. And if it no longer fits the definition of an asset, we need to remove it from being an asset. Assets have debit balances. To remove an asset or to decrease it, you need to credit the asset account. And if you're crediting the asset account, you will debit the other account affected. So that's why you're seeing debit bad debts and credit account receivable slash Yoshida. All right, that's 2 marks. And the last question on this side says, identify 2 causes of depreciation. Okay, so I gave you guys more than 2. So the first one is wear and tear or use. The more you use an asset, the more it wears down. The more you wear your shoes, the more scraped the soles of the shoes become. The more you use your phone, you drop it and whatnot, it gets damaged, all right? So wear and tear. Next, obsolescence. So obsolescence comes from the word obsolete. When something becomes obsolete, as when a newer model comes out. The same phone you have in your hand, a few years ago when you bought it and it was the hot new thing, right? It was worth a lot of money. Now a few years have passed and a newer model has come out that makes your own, and you're craving the newer model despite the fact that you don't really need much of the features it has, right? But the newer model is more capable, has more features, does what your phone has and does it better, all right? So your older phone has now gone down in value because something better exists, all right? There's also one called passage of time. This is basically where time passes and things age, and as things get older, their value declines. Okay, and the last one for you all is depletion. So this has to do more with like assets such as, let's say, oil fields, gas fields, quarries, even I guess they could say like plantations with crops and fruits and these things. When the oil company or the gas company extracts oil or gas from the oil field, there's less of that inside of the field. There's less left after you've taken out some, which means the value of that field, the asset, has gone down. So the more you extract from it is the less value you have left, all right? Okay, so ladies and gents, that has been the Jan 2021 POA Paper 2 Question 1 solution. Again, if you guys have any questions, please feel free to leave them in the comment section below. And again, once I get all 5 questions done, I'm going to put a link to the entire playlist in the description below. And again, guys, if you have any feedback regarding the quality of the video, the layout, etc., if things were too small, if you liked or preferred this layout relative to swapping between the questions paper and the answers, please let me know. Anyhow, guys, that's about it for me for today. I'll see you next time. Thanks for watching. Bye.